Good afternoon, everyone, and thank you for joining us. We're delighted today to have Frazer Bourchier, the CEO of Mandalay Resources, here with us to tell you a little bit about the story. Mandalay has been on a roll. Year over year, last year, the stock was up about 114% in trading, and it's come out of the blocks pretty strong this year as well. It's up around 9% so far year to date. Mandalay is trading in and around 430 Canadian per share. We cover the stock and have a $7.50 share price target on the company, which reflects our long-term gold price assumption of $2,400 and a long-term antimony price of $13,000, which is considerably lower than where it is in the spot market today. Mandalay, like I say, has been on a really good run recently. It's a solid producer with a couple of mines. The company is looking to remain stable as a producer and then ultimately grow into a mid-tier size. So with that, between myself and Frazer, we may be providing you with some forward-looking statements. Please take a look at the disclosures on their presentation, and I'm going to pass this conversation over to Frazer to tell us a little bit more. Frazer?
Thank you very much. I appreciate that introduction, Ron, and welcome and thank you to everyone who's taken the time out of their schedule to join. I will speak for 20-25 minutes at most, I think, here, and then certainly welcome any questions afterwards that you may have about our story. Some of you may be aware of it and may be new to others. So Mandalay Resources, the name's been around, the company's been around for 14 or 15 years. I joined a year and a half ago to grow the company, and we are a mid-tier, what we would call a mid-tier gold producer with antimony as well, in addition to gold, primary gold. So as Ron stated, I caution, of course, everything we make in terms of forward-looking statements, the caveats around that, no guarantees, although, we feel strongly about what we think the future can be. But as Ron suggested, please read those as a caveat around the presentation. So stepping back, Mandalay Resources, who are we? What are we? We are a diversified producer. By diversified, both in terms of metal, gold primarily, but also antimony, which I'll get into a little bit later, and also diversified in terms of asset. We're not a single asset producer. We are a multi-asset producer, 2 assets, one in Australia and one in Sweden. Top, what we would call tier 1 jurisdictions with very little sovereign risk. We have a leadership team of which, as I stated, I came in 18 months ago to lead this new chapter for Mandalay in terms of growth. And we've had some success so far, and I will talk about the future plans. Myself, back in the day, I was a mining engineer by training. I've been in the business for 36 years. We are based here in Toronto. We have a pretty lean office. I've got 3 people here, 1 in Vancouver and a few in Australia. I don't believe in large leadership teams. The work happens out at the mine sites. We also have a good history of 15 years in Australia of replacing our resources, which I'll get into, in reserves, of course, so keeping that mine life relatively consistent. And for 10 years, since we've owned the asset in Sweden, the same thing there at the Björkdal asset in Sweden, of replacing those resources and reserves so we can continue to mine and produce metal and generate cash flow. Cash flow generation, all dollars I refer to in this presentation are US dollars. We generated about $5 million a month, or $45 million in the first 9 months. You would have seen or may have seen our press release, which was a flash. It's not the full earnings statement, but it stated what our cash was at the end of the year. So if you add to that, that was the same $5 to $6 million US dollars free cash after all expenses, after all capital, after all exploration and G&A. That puts us to $76 million. So that was another $5 or $6 million a month we made for the last 3 months of this year. So a healthy operating cash flow, very healthy, operating cash flow, but also very healthy free cash flow, and a healthy balance sheet with zero debt, even though we have a large revolver, which I'll get into, and 76 million in cash. The vision, reestablished or created a new vision, really, as we made it clear. There was a time, I think 2-3 years ago, they were looking at maybe a sale of the company. There was a different leadership team, a slightly different board. I came in with a new vision in terms of helping to be part of that consolidation in what we would call the mid-tier market of gold producers, getting 300,000 to 500,000 ounces per year equivalent in the next 3 to 5 years from our current 100,000 ounces a year. And that would focus on 3 pillars. One is cash flow from operations. The second was organic exploration. That gets into the story of replacing our resources and reserves as we go along and growing where we can at those 2 operations. But the third related to mergers and acquisitions, non-dilutive, friendly, accretive combinations to help with size and scale, trading liquidity, coupled with the organic growth, adding in potential inorganic growth. As Ron referred to earlier, this is a snapshot. I mean, the price, this is a few days ago, the price is up to $4.30 a share. But, let's call that all up at 98 million shares outstanding. We're just over 400 million market cap Canadian. That's about 280 million US market cap. So, and 25% of that is sitting in cash. And enterprise value, the number's a bit higher now, maybe close to 100, 190, 195 million US. Share price growth, 1.5 times if you come off the low of what we had at the end of Q1 last year before we started announcing our quarterly results. And due to a number of reasons, which we'll get into, that share price has grown, but we think there's lots more room for movement as our P to cash flow multiples are still only around 2.5. Most of our peers are around 7. And our PNAV, by external analysts might be anywhere from 0.5 to 0.6. We still think there's room to grow there. And we have a fairly concentrated shareholder base, but they're very keen and committed to growth and allowing for and introducing new retail and institutional investors in part of that growth story. So they've been supportive, but they're very aligned with the vision and corporate strategy I've set up for the company. In terms of the team, if you kind of take this team here, split it, a line down the middle of the page. On the left, let's call it the new team that came in to drive this growth story. Myself, as I stated, with over 35 years in mining operations in the mining industry. I brought in a strong corporate development officer, Scott Treblecock. He has over 26 years in the business, an engineer by training initially, but is involved in financial M&A activities and growth, as evidenced by his years at Nevson Resources, for example, that sold out for several billion to Zijin Mining, and other examples. And then I recently, about 10 months ago, brought in a new CFO based here in Toronto with me, Hashim Ahmed, ex-Barrick, was with Jaguar Mining for a 6-year stint when their share price had tripled over that period of time. And then temporarily recently went to Nova, where that was sold out, and he joined us. So we're happy to have him. On the right-hand side of this page really is a representation of what I would call strong institutional knowledge. I mean, Ryan Astaberry, our Chief Operating Officer, and Chris Davis, our VP of Exploration, have been with Mandalay Resources for 15 years, along with Edison McGuinn, our business development valuations IR fellow here in Toronto with me. So they have good history of the operation. Ryan and Chris are based in Australia, next to one of our two operations, the Costerfield mine, which I will speak to. And that works for now. So, between the new team, the institutional team, all have had experience with growth at different companies and exploration and operational success. Over 80 years for just the three of us on the left in terms of experience. I believe this really underpins our growth strategy. On this slide, really simplistically, just the takeaway are two operations. One in Australia on the top left. You'll see the small red circle there. It's called the Costerfield mine. This is a underground mine. It's 30 kilometers away from Agnico Eagle's large Fosterville mine. Same reef system. It's the Bendigo-Ballarat belt. I mean, this has produced over 57 million ounces of gold in its history. It's really what built the city of Melbourne. And it's a residential operation. This is not fly in, fly out in the state of Victoria of Australia. Whereas the picture below, the map below, is showing where our Swedish operation is. It's called the Björkdal operation, red circle up near the top. That's about a 1-hour flight north of Stockholm. Despite it being at the Arctic Circle latitude, it's a residential, very modern town in the town of Skellefteå. Over 30,000 people live there. We are literally adjacent to one of Boliden's operation. In fact, it was their starter operation. They have about 5 operations and 4 or 5 smelters, but the Boliden operation next to us has been operating for about 100 years. It started with a large gold deposit, although they are really a large polymetallic producer. So again, in very prospective area. Costerfield, which we'll get into, has been operating since 1862 off and on. So, there's over 150 years of history there. Where Björkdal has been operating since 1988. Used to be an open pit underground. It is now underground operation. And then the last takeaway here, again, we have no royalties. We have no streams. We have no encumbrances. Clean debt, no debt. In elephant country, as the term is used for both our operations, tier 1 jurisdictions. And our cash costs, AISC costs, are represented by the circles on the bottom. We generally produce 50,000 ounces at each, about 90 to 100,000 ounces. We just put out our results a few days ago for last year at about 97,000. A little bit lower this year at 85 to 95,000 ounces. However, that is a temporary blip, as it's mainly driven by our Australian operation, which is going through a lower grade portion of that mine before it kicks back up again next year. As a result, the denominator ounces is lower. 70% of our costs are fixed. So hence the AISC costs go up somewhat there, which is a little bit abnormal. That'll come back down again. And that's because we have both fewer ounces that year when you divide by that to come up with your all-in sustaining cost per ounce. But also we're investing a fair bit of capital this year in terms of a tails dam, which I'll get into at the Costerfield, and into our property, plant, and equipment. So that still gives us, 30+% margins at today's gold price for our equivalent ounce production profile. So in summary, in terms of cash flow generation and our strong balance sheet, $76 million US in cash, 0 debt. It's a $35 million revolving credit facility, which we plan to increase in that support, take that up to $50 million. That's with Scotiabank. So very supportive, healthy access to liquidity between working capital and our revolver, coupled with equity if ever needed. And these are some of the metrics on the left and the amount of cash flow we've generated over the last 3 years. Weigh this all up on the backdrop of a fairly small, I'll use that term, market cap company of 270 to 280 million US. On this slide here, really, there are three takeaways in terms of exploration, which I spoke to, of historically replacing our resources through successful organic exploration on our tenements. The graph on the top is the Costerfield mine in Australia. The gray represents the cumulative depletion of ounces we produce over time for the 15 years we've been there. The orange on top of that is the somewhat up and down, but the general replacement or resources that we generate. So generally speaking, we've been down the last year or two, but we expect that to flatline and start to go up again in terms of the resources that we're able to find. And then at Björkdal, it's even more consistent down on the bottom. Again, the gray represents the depletion, and the orange represents the resource number, which stays pretty consistent. We tend to replace every year of what we produce, we replace in resources and reserves. The mine life, the second takeaway is the mine life is about 3 to 5 years at Costerfield. However, it has been 3 to 5 years or 2 to 5 years for the last 15 years. So we kind of have that continued cycle. Whereas at Björkdal down below, it's about an 8 to 10 year mine life, and that's been fairly consistent. The final takeaway, apart from resource replacement, and by the way, you can see relatively cheap resource replacement. That's $15 per gold ounce at Björkdal. That's about 1% of the spot price, and $40 or so for every gold equivalent ounce at Costerfield, which is about 2% of the spot price. But historically, we've spent about 7 to 8 million US exploration on both properties. But in the last year to 2 years, I've upped that to 10 to 15 million, so close to doubling. And that's represented by, you can see those gray stacked bars on the right, especially at Costerfield, as we ramp that up with some excitement on both our near mine and regional exploration focus on gold and antimony reserves. Okay, I'll go into the operations each a little bit and then step back and do an overall summary. At the Costerfield mine, generally speaking, that's close to a 50,000 ounce a year producer. This year, it's a little bit less, 43 to 48,000 gold equivalent ounces with gold and antimony combined. But that's predominantly because we're going through a section of the mine which has slightly lower grades. So this is not a throughput issue. The throughput of the plant continues to be maximized. Running cash costs of let's call it $1,100, so it's a pretty good margin. Even all-in AISC, which includes a large tails dam that we're putting in this year, that gives us, or finishing this year by April, which gives us an extra 7-year mine life. Because we're confident that we will continue to extend the mine life. Even at $1,500 to $1,600, that's still a pretty healthy margin. We can generate between 40 to 50 or 60 million US a year free cash flow from this operation. This slide here you're looking at is a section view of the mine. That's about, from left to right, it's probably about 2 miles in strike length. Those represent some of the previous mines. Up in the top, that's all grayed out, are the historic workings. Over on the right, you will see something called Ewell. That was a notable deposit that was found about 5 years ago, where the mine is actively mining, which transitioned the company at that time back in 2019. We then discovered the Shepherd deposit over the last year or two. That's below that. And that is, it's not yet as extensive as Ewell, and the antimony grades get a little bit lower as you get deeper, and the ore a little bit harder. However, it's a key focus area for us, and it didn't mean we were going to replicate Ewell exactly. But what has us just as excited this year as we continue to mine Ewell and Shepherd on the right is on the left, we will be ramping up our near mine exploration with a fair bit of vigor as we put out an exploration drive and get ideal access to what we call Cuffley Deeps in the sub-KC. You will see, just out of interest, in the yellow box, that was maybe 3-4 months ago, some drill results, pretty impressive grades, anywhere from 30 to 500 grams a ton. and 17 to 30% stibnite, which is the antimony ore. One may look at that and go, well, those are over pretty narrow widths, like 0.8 meters and 1 meter. We mine these deposits 1.5 meters wide. These are narrow vein deposits that we mine with very narrow LHDs or scoops or boggers, whatever term you're familiar with for underground mining equipment, remote controlled. So it's not a big stretch to sort of even dilute that by 50%, and those are still good grades. I mean, this is one of the highest underground gold grade mines in the world. It is smaller. We understand that. And the throughput is lower, but that's why the margins are so healthy, and we continue to have that success. So Shepherd Surrounds and Cuffley Deeps, somewhat Brunswick Deeps we'll look at as well, but those number 1 and 3 are main focus areas for what I would call near mine exploration or extension this year. Stepping back, bird's eye view or plan view of the same operation at Costerfield. What I just showed you is what we call the central corridor. So that's in the center, those number 4s, where we're focusing on that Cuffley Deeps in the Shepherd. You know, we produced approaching 2 million ounces out of this area since we came in there and a bit before that. However, what has us very focused on the regional land package, this is our land package all in gray here, is especially True Blue. There'll be a press release coming out in a few weeks' time that updates some initial exciting results on this discovery. And that will be most of our energy spent there, as well as the Costerfield plunge, to a lesser extent Browns Corridor. But True Blue on the left, we feel has the chance to replicate that central corridor. Some of the results are quite interesting. They're closer to surface, which has benefits on many fronts, including access, and the antimony grades tend to be higher closer to surface than at depth. So that's really a snapshot. At this operation between near mine and regional, we'll probably spend 8 to 9 million US in exploration in the first half of the year. That may well ramp up based on results and success we have, that we will update the market as the year progresses. Just a quick one on antimony I want to speak to. I mean, this is 2 things I'll speak to. One is the price, and the other is the uses. The price, as Ron shared, kind of plodded along about $10,000 US per ton of metal. I should convert that into dollars per pound. I don't have that in front of me right now. I think it's $10 per pound. But that price has doubled to tripled to 3 times, even more over the last year. And there are reasons for that. And that's really based on declining reserves. And then there were 2 different announcements last year. One from China, because 85% of all the antimony that's produced, which is a critical mineral, and I'll get into its uses on the left, but 85% of all the antimony produced in the world comes from either China, Russia, or Tajikistan. That means, by default, 15% comes from the other places, of which we are a main producer of that. In fact, even though it's not by intent, we are the largest producer, not exploration play. We are the largest producer of antimony in our concentrates in the Western world. And, so there were 2 announcements. One was an export ban mentioned by China in late August in terms of some restrictions on exporting the antimony that they smelt within their country. And they smelt by both concentrate coming into their country from other countries of antimony and their own internal supply and their reserves. That was followed up by maybe a much more, because they're running out of reserves and they have use for it in country. That was followed up by maybe a much more alarming statement on December the 2nd, to be exact, which triggered the next antimony price increase, where the Chinese mentioned that they would put a full restriction, not a partial restriction, on antimony metal export. And they particularly targeted the US. I mean, we won't get into the potential politics of that and the reasons for that. I think they added a few other critical minerals that they were not going to export as well, including palladium and I can't remember the other one. I think it was iridium. But antimony, that certainly triggered the price. So it went from about $10,000 a ton a year ago to what they call a fast markets price that is anywhere from $35,000 to $40,000 a ton. There are different prices. There's a lower price that pays higher payables, called the Shanghai price, and that's what the Chinese may be willing to pay for it. But at the end of the day, this has been significant for us. It used to represent 10% of our revenue at our Costerfield operation. That's probably closer to 25% of the revenue. That's an extra 10 million, 15 million US kicker. Kind of comes along for the ride in our concentrate. So that's certainly been a benefit. We believe we have a fair bit of knowledge. We're about the only producer of antimony. We are the only producer of antimony in Australia. We have first mover advantage. We have knowledge of it. We have a flotation plant that produces gold and antimony concentrate. And even though you see those bars on the bottom where the amount of antimony has decreased over the last 3 years from about 2,300 tons per year to, we put our guidance up for this year of about 1 to 1,100 tons. We believe that number eventually will change as we target some of these more shallower deposits on our exploration success, but it's still significant for us. And to the uses, high-end fire retardants, 50% of antimony is used in high-end fire retardants. It's used both as a hardener and to ensure air bubbles are not trapped within solar panels as they're manufactured, and then in lead antimony solid-state batteries. The fourth use we don't speak a lot about, and it's obviously a more sensitive use, but it's not new. It's been around for 100 years, is in munitions to harden the steel in ammunition. So, all those reasons combined, especially I would say driven by the solar panel, of which China makes a lot of solar panels, both for export and internal consumption, the dwindling supply of antimony, and maybe some of those other uses as it ramps up, strategic or otherwise, has led to, coupled with the export ban, the increase in antimony price. Moving on to the second mine, as I wind down here, again similar. This operation, 40 to 45,000 ounces a year. Margins are a bit lower. This operation is 10 times larger in area than our mine in Australia. It is 10 times larger volume, as in process throughput at the process plant, but it's probably about 1/10 the grade. So the margins are smaller, but we can still generate anywhere from 10 to 25 million US a year at this operation. It is massive. We believe it'll go on for a long time. Looking at this picture, this is an isometric view. It used to be open pit back in the day in 1988. About 2019, it progressed to an underground operation. That blue angled sheeted vein you see there, that's actually a marble unit. It's just used as a differentiator. The ore veins above that unit are somewhat larger and more bulk mining, but lower grades, about 1.3, 1.4 grams a ton. It's called the Aurora Zone. And then underneath the marble unit tend to be narrower veins, but they're higher grade. So in the area we focus on the most is both Eastern Extension and then a recent press release we put out on December the 18th on what we're pretty excited about, the North Zone. So both higher grades, north of 2 grams a ton, but also it looks like it could expand significantly, and it's much more continuous in its metal content. So we'll update the market as the year progresses on that North Zone, as well as the focus on the Eastern Extension. And then again, like I did with the mine in Australia, my next slide here is just a bird's eye view, plan view of what I showed you earlier, that gold star in the middle of the page. That represents what we just showed you in the isometric view. That's the Björkdal operation. Historically, over 1.5 million ounces we produced there. It's about about 11 kilometers from Boleden's original open pit that started that whole operation next door to us. It was a much higher grade and larger gold deposit. These are all hosted within a VMS deposit. But we are also focused on, what's of interest to us is two other deposits that are, let's call it Bjorkdale style gold sheeted veining. One is Storheden, you'll see in the top. That's about 1.5 kilometers away from the underground working, so very doable in terms of access. We'll be drilling that out this year. And then Norberriet, that number 2, further over to the right. That looks like that could be a higher grade and a starter pit before it goes underground. So a satellite pit would be fantastic. That would be a nice, margin. We could truck that easily over to our process plant to complement our average 1.5, 1.6 gram per ton feed through our 4,000 ton per day operating plant. We do have a large stockpile, by the way, which is a hangover from the open pit mining at about half the grade or a third of the grade of our underground mine. Decent margins, because all you need is a loader to pick it up and put it into the plant. But we tend to minimize the throughput of our plant with maybe 25% of that surface stockpile. We prefer to focus on the underground, which is higher grade, which means we need a bit more development there to get more working faces, so we have more flexibility, so we can feed the majority of the mill with underground ore feed. So in closing, before we open it up to questions you may have, we are a diversified gold and antimony producer, great jurisdictions with a leadership team. I can certainly speak to my history on that. Replacing resources as we go along, generating cash, a very healthy balance sheet, continuing to generate cash, no debt, and our focus remains on the operations and organic exploration. But we are looking for that next catalyst step that can help us get larger in size and scale while increasing significantly our trading liquidity. And we've certainly gained a lot of interest, especially in the last 4 or 5 months as this story starts to take off in the market. On that point, I will pause and hand back to Ron Stewart, who I was thinking of, thinking about hockey there for a minute. Ron Stewart, who may have some questions that have come in on the chat room.
Hey, Frazer, that's fine. We've got a few questions here from our listeners. The first one is, if antimony price remains in the order of $35,000 a ton, how much would that impact your earnings in 25?
Our earnings, it would probably, if it remains around that, based on the guidance, of course, we don't give guidance in terms of earnings and cash generations, but let's say it would not only give us more confidence in earnings, it probably can add anywhere from 10 to 15%. So, that's a bit of a generalized statement, but it's healthy. As I say, this, has added 10 million in revenue based on what the prices were a year ago. And represents 25% of our revenue at the Costerfield operation, which is 70% of all our revenue in the company.
Correct. No, I understand. And just again on antimony, is there any flexibility to be able to change your mine plan to go after some of the higher grade areas, or are you pretty much fixed with where you're headed right now?
Yes and no. We have certainly are specifically looking, I would say, at older remnant mining to add into the mix, which tended to be higher grade antimony at surface. But it is intermixed. It's not like there's an antimony or stibnite section of the mine and a gold section of the mine. The veins are adjacent. They're mined together. So that's what I mean by it comes along for the ride. But certainly, it's changed what I would call the NSR, net smelter return of the, per cubic yard or meter of rock in underground. And it's allowed us to go back and revisit some of that. In addition to what I spoke about earlier, which there'll be a press release coming out in a few weeks of the regional exploration, which may be 3 or 4 years out before it gets into our mill. But that certainly, that shallower stuff, having antimony prices where that makes that even more economic potentially economic and a real benefit.
Certainly, it's an attractive target. There's no question about it. One of our other listeners asked, with such a healthy cash balance, do you have any other plans for the uses of cash? You're doing some exploration, that's fine, but you're sitting with a quarter of your market value in cash. What are you thinking about in terms of cash uses?
So there's three things we're considering. One is the first, yes, do we even ramp up exploration more, especially at Costerfield, focused on gold and now antimony, particularly in the regional play. So that's one use we're considering, how we expand that. The second is in the event of a, let's call it at market combination, whether it's an asset purchase or a turnaround operation or a company that maybe has even more exploration and not bad cash flow, but needs to unlock some of their capital, we could look at a clear use of proceeds and invest that into the pro forma company. And the third is we are certainly stepping back now and considering a dividend if it makes sense. Not promising that, but does some sort of dividend make sense going forward? I'm a firm believer that dividends is a fair return to shareholders on the condition that we're sure we can sustain that for at least 2 to 3 years. I don't like to turn the tap on and off. I think it gets somewhat confusing for shareholders if you pay dividends for a while and then stop that. So, a year ago that was off the table. Now it's certainly being considered, as in, is that something we do, and at what time would we consider paying even a 3 to 4% yield dividend?
Yeah, that was one of our other questions. One of the listeners was interested in the dividend, and oftentimes we get asked about NCIBs as well. But when you're looking at a company that has interests in growing and expanding the business, doing an NCIB can be a bit of a double-edged sword.
Yeah, well, we do have an NCIB open. We've exercised it somewhat. It's extremely, especially apart from a special buyback, it's quite restrictive in how much you can really buy based on the percent of your float and time of the day. So it's not significant, but we have tapped into that even as our share price grows. But we do think there could be better uses for our money than necessarily going all in on a special buyback or NCIB.
Okay, and just one of the things that came up during our conversation today, you'd mentioned, if we use a $12,000 a ton cost or price for antimony, that equates to around $5.40 a pound. You divide it by 22.04 to get the dollar per pound. So at current prices of $35,000 a ton, we're talking $15.50, $15.60 a pound of antimony. And one of our listeners was interested in your forecast for antimony production for the year. Can you just recap that, please?
Yeah, the forecast for the year is between 1,000 to 1,200 metric tons. So you can multiply by 2,200 to come up to the pounds equivalent for that. I don't have that right on the top of my head, but 1,000 to 1,200 metric tons times 2,200 for pounds. That, of course, excuse me, is nothing to do with increase in reserves and exploration success we may have on antimony, but that's what they produce. And when I quote that, I want to be clear, that's not the tons of concentrate of which the antimony is in. That's not even the tons of antimony metal. We quote the estimated tons of payable metal, because you can be paid anywhere from 50 to 80% of your antimony, depending on where you send your concentrate. So that is the actual payable metal number I'm giving you.
I see. Okay, no, that's good to know. Then a couple of other interesting questions. Do you have any video footage of narrow vein mining that you're doing at Costerfield? One of our listeners would be really interested in seeing how the mining is actually accomplished. I don't know if you have anything that would.
Yeah, I mean, we have short little snippets. If you, there's not a lot that come up. Maybe we'll change that story. If you Google or YouTube Mandalay Resources on some old video, there's one from a few years back where we had some. It wasn't stock footage; it's actually footage of our operation. It's a fair point. I can certainly look at getting some of that loaded up to our website. Especially, I think what your viewer the question may be asking references the narrow vein mining tele-remote loaders. So that's a great question, and I'll looking at getting some of that footage loaded up to our website.
No, that's fine, Frazer. And we're actually seeing a lot of interest here, but the questions are kind of rolling in. Is there any change to the mill circuit that you have to do to accommodate the different amounts of antimony, or when you float the concentrates, do you just process the material the way it comes in and whatnot? It's set up to capture the concentrates?
Yeah, so that's a great question. I mean, so there's two parts to that I'll answer. The first might not be the direct question. As far as the capacity, I mean, people may hear 400 tons a day and think, wow, that's a pretty small plant, even though it generates great margins. Would you ever look at expanding the size of that plant? For now, no, but we only say that because, I've got a 3 to 5 year mine life. If I doubled the plant, I'm down to 1.5 year mine life. And while we can certainly replace that, you're on a much faster running treadmill to try and do that. So we wouldn't, until we get comfort that we can expand this to a 6-7 year, we're somewhat restricted in terms of the orientation of the ore body to do that. But as far as the actual flotation circuit, which I think the question refers more to, we float. No, the short answer is no. Higher antimony doesn't have a negative impact. It doesn't change the circuit. What we do is we pull out a gravity gold middlings that we send to a refiner and smelter. That maybe represents 40 to 50% of the value of everything at that operation. And then the rest floats into a gold antimony concentrate. So if we get more antimony, it just means the concentration of that antimony is higher in the con that we send off. And we try to pull more gold off. The only reason we try to pull more gold off is when you send that gold antimony concentrate, the biggest negotiation and debate you have with players isn't so much how much they'll pay you for the antimony. That's part of it. It's how much they'll pay you for the gold. And there are very few smelters that can deal sufficiently with that gold. They'll take it all right, but I want to know what price they'll take it at. So we have to make sure we get a fair price, not just for the antimony that's sitting in that concentrate dirt, but also the gold that's in there. So the more we can reduce that gold within reason, it makes those negotiations easier. But that's a long answer to the question. The short answer, no, it doesn't have a negative impact. We don't have to change the circuit if we get higher grade antimony in our ore, still in our ore.
Fair enough. One of our other listeners is interested in the notion of M&A and basically, pointing out the fact of the challenge of M&A with valuations and thinking that it'd be nicer to see a higher valuation ahead of any M&A. I think honestly, I think in your presentation you talked about being prudent and thoughtful about the right kind of M&A. So I don't know if that's a question so much as just a comment. He's saying that would love to see the right kind of deal done, but is mindful of the fact that M&A can be tricky.
100% agree. I mean, look, we've been at this pretty exhaustively for a year. It's not because we're overly conservative, but we surely do not want to dilute ourselves. We won't go hostile. That's not the idea. This would be friendly. So there has to be an agreement and understanding, of which we have those discussions with boards and executive, that there's a shared view of alignment and vision on the strategy. Point taken, let's say, for example, one were to believe our PNAV is 0.5. I would say to have a stronger valuation, it really all depends what you think the PNAV is of the company you're doing the combination with. If they're around 0.52, then it's not dilutive. If they're around 0.3, it's even a better deal for us. If they're around 0.8 or 0.9, then it's diluted, point taken. So part of that is not just your own valuation, but the respective valuation of the other party you're looking at doing a combination with. And also it depends too, as far as, ensuring the social issues, executive and board, can combine and it's friendly. And the understanding is the real value comes from size, scale, index listing, getting on the JDXJ, and then a re-rate, if that makes sense. So we're very, diligent and prudent about that. We're not going to blow our brains out on anything stupid. The other option are asset purchases as opposed to market combinations. it's not a large universe out there. I agree that have market caps between, let's call it 100 and 500 million that are producers. But we would certainly consider asset purchases as well. In this market, they tend to be a lot more expensive. You can look at examples like Orla and others. However, if it's the right deal and it gives a lot of growth in mine life, then we're certainly open to that as well.
No, I appreciate that. And, it's the process of leaving no stone unturned. You have to look at a lot of things before you find the right one. Another question, one of our listeners was curious as to whether or not you've ever considered a U.S. listing.
Look, we have considered both an Australian listing and a U.S. listing. And the short answer is yes, we've considered it. There are pros and cons. Sometimes the cost to list and listing for just the reason to list may not override in our view as being a benefit. However, it certainly opens you up to a broader market, especially maybe in the U.S. And it may come concurrent with M&A activity, then that would be ideal. So we haven't done it yet, but we are considering it and weighing up the cost, the trade benefit of time, energy to list, but does it open us up to a larger potential range of investors? I mean, we are available on the OTC and over market for American investors. We have a number of them, but that's certainly a possibility we could look at.
We have a question here regarding the environmental liabilities. I think it's related to the Lupin project. When do you feel that those will be completely discharged?
The plan with Lupin, assuming we don't turn that into an exploration license, I mean, that was shut down when gold was, should be careful what I say, but that was shut down when gold was 1,000, or I think it was $500, $600 an ounce, $2,700 now. We should relook at that. That's not the intent, however. We think within 2 to 3 years that should be all closed up, apart from ongoing monitoring. So, net of costs to do final overburden cover, and then with reselling some final equipment and getting our securities released back from the government, net, we don't see that being more than a 5 to 10 million, not insignificant cost, but we think within 3 years that should be all tidied up, and then there'd be a running cost that's in the decimal places of millions just to do ongoing monitoring.
Can you just recap quickly the CapEx spend at Costerfield and Bjorkdale for the year, and specifically how much is going into the tailings facility at Costerfield?
Yeah, so I'm going to go very high level. Roughly, it's about 20 million, 23 million US at each. And that's split between investment in property, plant, and equipment, mobile equipment, especially as we invest in both operations fleets. It's about the 10 to 13 million in exploration included in that, split sort of 70-30, Costerfield to Bjorkdal. And then it's the increased capital development at Bjorkdal was about 4 or 5 million. And then the tails dam, as was asked specifically at Costerfield, about 6 million US this year of that 20 to 23 million at each operation. It Costerfield about 6 million.
Thanks, Frazer. And again, we've got another question on Costerfield regarding the Shepherd Yule zones and whether or not you'll be moving to the True Blue, and would you expect grades from the same sort of grades that we've seen in recent years from the True Blue?
We think so. So a couple things. Look, it is earlier stage. So these are inferred resources. We're moving into larger resources in M&I. So it's not a reserve yet. So I want to caveat that. You will see the press release, and there'll be some very interesting grade intercepts. We have no reason to not believe that it won't be as good grades as in the past, but let's let that process roll out and watch the press releases this year. When we do talk about those regional targets, to me, they're not a long ways out, even though there's not a mining license on those. We have exploration licenses, but in the state of Victoria, fairly supportive. It wouldn't take us too long to get those converted, but those are probably, I would say 3 to 6 years out in terms of the time we drilled it out, saw something, and then whether it's underground access or surface trucking, tow milling, it's probably more, let's call it 5 years before you would see that going into the plant, which for us, if it works out, is good timing as we continue to replace our near mine reserves, but we have this 3 to 5 year life. It would be nice to, get that to be a 5 to 7 year mine life at Costerfield.
I understand. Finally, one of the comments just came in, patting you on the back for doing this. It's a real pleasure to be able to contact and talk to you right now about the plans and have this conversation. And just judging by the interest that we've got from the listeners, obviously people are very keen. So well done, Frazer. I just want to...
thank you.
Sorry, go ahead.
No, just saying thank people for their time. I mean, I understand the industry and the excitement, but also the risks that come with it. But hopefully I've been clear and as transparent as I can be.
No, and you've done a good job. And I just want to recap, like I said, I covered the stock. I've got a $7.50 per share target on it. Using our price deck, we've got gold at $2,400 for the long term. In my estimates, Mandalay is currently trading at around 3 times cash flow. And you heard earlier that, Frazer was saying that, he can generate $40-ish million in free cash flow from Costerfield, another $20 million from Bjorkdale. So we're looking at a company with a strong cash balance, trading at a low price to cash flow, and the price to net asset value in my model is 0.5 times. So there's certainly room to move up here. As we go forward, I think the company has been very solid. And one of the things that I don't think that most people really appreciate is that underground mines having a 3 to 5 year mine life is a prudent way to go. These mines have been going on for over a decade, each of them for over a decade, with a 3 to 5 year mine life. There's really no point in drilling out reserves and suggesting that we've got a 10-year reserve life when you won't be mining something for 7 or 8 years. I think the indications are there. So in my model, I've extended the mines out to around 10 years. I think that's a reasonable way to look at the future. I think Mandalay has a great future, and we really appreciate your time, Frazer, in talking to your shareholders.
Yeah, thank you, Ron, for hosting and setting up this call. And again, I can't see the number of people that dialed in, but hopefully I do appreciate their time, and any follow-up questions I can certainly address directly or through my IR individual or through you, Ron. So that's great. Thank you.
All right. Well, listen, have a great afternoon, and thank you for joining us.